All right, so welcome into the live stream today. We're going to be diving in, of course, to Ethereum post-merge day, what this may look like overall for you guys out there trying to play the merge and really understand the future of where Ethereum is going, but also some of the pressures that the market are presenting. And of course, that will play into Bitcoin and some other tokens. We'll try to break all that stuff down. We do have a special guest joining us today as well, so it's going to be a fun one. My name is Paul Barrow. Welcome back into TechPath. Let's jump into it today. And of course, one of the things that many people have been asking us is, what is the direction for Ethereum post-merge? How will this play out? As you guys know, we just did a video earlier today breaking down some of the aspects of not only sentiment, but where the market is trending. So one of the companies and crew that I really watch a lot of is the team over at CryptoBanter. So we thought, let's get Ran on the show and kind of break into what's happening. So I want to welcome Ran over from CryptoBanter. Great to see you, man.
Paul, good to see you, my friend. How are you?
Excellent, excellent. So we're going to get into it a little bit today. Many people, I think, that follow our show probably know who CryptoBanter is, but just a quick rundown of your channel. I know you've got a full team over there that really focuses in on trading and analysis. You go into the macro side. Anything that you guys are doing that's new?
Well, I mean, I think we're trying to build 24/7, 365 credible crypto streaming. The reason for that is, in traditional markets, if you want to know what's happening on the markets, you can turn on to CNBC or Bloomberg or whatever your go-to place is.
Right.
And within 10, 15 minutes, you know exactly what's happening on the market from a credible source. In crypto, if you want to know what's happening on the market right now, it's very hard for you to do stuff. So you can either go onto Twitter, and Twitter's full of noise. You know how much noise Twitter's got. You can open your Telegram. Good luck if you open your Telegram. Or you can watch YouTube. And the problem with YouTube is that the majority of YouTubers are paid. And the problem is when they're paid, you don't know whether they're telling you about a token or a strategy because they actually believe in it or because they're paid. So we decided that we're going to start a 24/7, 365 live credible crypto streaming station. And we're not going to do token reviews and paid reviews and stuff like that. And that's pretty much what we set out to do. Today we do 5 hours of programming every single day, 2 technical shows, a gaming show. I do a fundamental show once a day, and then we have a DeFi show and a deep dive show every single day.
Cool stuff. I always love it. Watched Sheldon quite a bit. Obviously, the guys, Johnny's been on the show here a couple of times on our gaming segments over on Metaverse Insider. So we've had some good times for sure. Let's get into post-merge. I know you guys streamed last night during the merge itself. And when you look at what's happening within the ETH ecosystem right now, how did this merge go? And obviously it's successful, but did this go the way that you felt it would go? Did you think we were going to see some pump, or did you think the market would do exactly what we're seeing now?
So let's start off with a technological view. Super impressed with the Ethereum devs and how seamless this thing has gone. You're talking about probably the biggest technological challenge ever. I mean, this is bigger than Y2K. This is one of the biggest technological challenges ever. And you could pretty much say that it went off without a hiccup. It went off smoothly. So hats off to the devs, hats off to everyone involved. You're talking about a decentralized team pulling off a feat like this. I think it's unparalleled in technological history. So that's a big tick. The second thing that we've got to be proud of is the fact that all the protocols on top of Ethereum all worked exactly as planned. I thought we may see some USDT, USDC issues, some replay attacks, some double spends. Nothing happened. Everything worked absolutely perfectly. From a price point of view, I was expecting a lot more, I'll be honest. And the reason I was expecting a lot more is there were 2 scenarios here. The one scenario was it was going to be a buy the rumor, sell the merge type scenario. And people got very excited pre-merge. ETH is up 100% in the last month or so. And I thought that maybe when the merge happens and people realize, okay, the merge has happened, gas fees haven't gone down, transaction throughput is exactly the same, the price would come down. So that was one option. The other option is that something would have gone wrong. And if something would have gone wrong, then I thought that all hell would break loose here. Mm-hmm. If a Uniswap failed or an Aave failed or USDT failed or something like that, then I was under the impression that we could have had a massive market correction. So what did I do to position for that? I put all my cash on non-ERC20. So I would not be affected if the ETH chain was halted.
Right.
I literally took all the spare cash that I had and put onto BUSD, onto Tron, onto any other network that wasn't Ethereum. And I woke up this morning. For me, it was very early morning. For you guys, it was night. And I was ready to trade. I came in ready, hot, itchy fingers, ready to trade. And the price moved a grand total of $50 during the entire merge. That
not necessarily a Super Bowl final. It's like one of those 15 to 14 games. Those are exciting, but not real exciting because you end up with kind of a ho-hum game. Well, that's interesting that you went that direction, because that was one of the things that we were talking about a couple of weeks prior to the merge, is kind of prepping for a potential catastrophe. Now, and I think you guys know we're a pretty conservative channel in terms of how our audience looks at the markets in general. And it's one of the things I'm always very cautious of, is especially around something on the technology side. My background in tech and understanding the difficulty level that you mentioned, I think was pretty significant. The fact that this went off without a hitch, I was even surprised that it went to this level, especially the fact that we didn't see a lot of kind of the additional protocols that were circling ETH as a whole in the ecosystem, also clean and green. So kudos to them. I was following the something last night. I know a lot of the streamers were getting on, is a site called Ultrasound Money. And when you go to this, I was just the number of things that it just kind of puts up in the face of you right now. Obviously, supply chain, just in the last 12 hours, 239 ETH already in terms of our burn on ETH supply growth, really changing a lot. I love the fact that this is so visual in really telling so much around what's going to happen, all the way down into gas fees. This was another thing that was kind of unanticipated, I think for me at least, was that we would see a little bit of a gas fee drop. Were you anticipating gas fees to go down?
I think that's more coincidental than as a result of the technology upgrade on the merge. So I'm going to go back one step and say, having seen what the Ethereum devs pulled off now, and seen what a decentralized bunch of devs in Ethereum managed to do, you really now have to back Ethereum to almost be able to do anything. The brain power, the coordination, you kind of got to say, look, if they pulled off the merge as seamlessly as they did, you got to back these guys, and these guys can pretty much achieve anything. So that's the first thing. Let's go back to your gas question. I think on that dashboard, the thing that is most exciting is the fact that ETH is now finally deflationary. Yeah. And you're in a position. So I mean, just for those who don't know exactly how it works, there are a certain number of emissions ETH created every day to reward the validators for validating and maintaining the network. At the same time, there's a protocol called EIP 1559, and that burns ETH with every single transaction. Now, up until now, EIP 1559 has been burning Ethereum with every transaction, but in most days, the proof of work rewards were bigger than the burn. Okay, so that's what happened. Today, for the first time, for the entire day, and I think you showed the number over there, I'm not sure how live my numbers are, but over 250 ETH have actually been burnt net today. So if you take the total issuance less the total burn of EIP 1559, today's one of the first days where we become naturally deflationary. And that's, for me, that's a turning point. So why is it such a turning point? Because I think the ETH merge represents something huge, and something which could potentially make Ethereum bigger than Bitcoin one day. And I don't want to get into arguments about the flippening and not the flippening, but now you have the second biggest cryptocurrency in the world that has enough liquidity for institutions to trade, which is ESG friendly, unlike Bitcoin. ESG friendly, you can't floor it for ESG. Has a yield. We have yet to see what the yield is, but indicative 5 to 8% today. So let's see how it goes going forward. Is deflationary as well. So you have a deflationary asset that generates real yield that is ESG friendly. And to me, that is a turning point. To me, it's an inflection point for Bitcoin and crypto. And I think, unfortunately, our excitement has been dampened by the macro factors. And I looked earlier, so the Nasdaq was down quite a bit. Let me just check again. But the Nasdaq was down, and the Nasdaq's down 3%, almost 2.5%, and that's taken down the crypto market with it.
Yeah, and I think to your point is that it really has positioned Ethereum in a very unique way. If you look at it on a head-to-head asset, this is something that I talked with the guys over at Bankless yesterday, pre-merge, and that is At what point does Ethereum and Bitcoin separate in the essence of market flow, where Bitcoin and Ethereum could run on its own in terms of how the market trends might go? Right now, and over the past year, really, since the last all-time high, we've seen Bitcoin and Ethereum almost track neck and neck. Do you see any separation between these two assets, or do you feel like this is always going to be the case?
So we did see a slight separation between Bitcoin and the altcoins and Bitcoin and Ethereum in the last month or so. And you've seen that if you look at the Bitcoin dominance.
Yep.
This is one of the only times where we've had a price correction or a price crash, but dominance has actually gone down as well, which means effectively, if you analyze that, what does it mean? It means that the altcoins have decoupled from Bitcoin. If you notice, Bitcoin bottomed at about, say, call it 18,000. And is struggling to break above a 23,000 level, whereas Ethereum bottomed at about $800 and has been as high as almost $2,000. So you can kind of see that there has been a separation between Bitcoin and Ethereum. But there's a big but here. And this is something that the world has to get used to, or the crypto world has to get used to. The problem is that now that we've created this amazing asset for institutional investors to invest in, because it's the second biggest cryptocurrency, because they're starting to understand it, because it's deflationary, because it earns a staking yield, because all the custodians support it, etc., because CME futures were launched on it, we've created another asset for the Wall Street institutions to come and buy in crypto land. Previously, it was only Bitcoin. Now, the problem with that is that institutional investors on Wall Street only have two settings, risk on and risk off. And when they go risk off risk assets completely, right? That's how they operate. And right now, they're very much risk off. And that's why Bitcoin goes down and the NASDAQ goes down. That's why all of a sudden we've got this huge correlation between Bitcoin and the NASDAQ. Because the majority of the buyers and sellers, not the hodlers, the majority of the buyers and sellers are now actually big Wall Street institutions. If you look at it from a volume point of view, it's not retail driving the market. It's not the hodlers driving the market, because hodlers like you and I are just holding. We're not selling. We're maybe buying, but we're not selling. And so what's happening is we're now falling into this Wall Street mentality of risk on or risk off, two simple settings. Now we're in risk off. And that means that Bitcoin and Ethereum are now going to become correlated. And if you want the non-correlated assets, you're probably going to have to find them somewhere else, not in Bitcoin and Ethereum.
Yeah, well, and I think obviously we track so many altcoins. Some of the things that, again, back to your point, that I look at around Ethereum, and this has been, a scenario for quite some time, is the ESG implications, what this really looks like. I was looking at a story from Finbold. This actually surprised me a little bit when I saw this chart. This was, Vitalik talking a little bit here, 0.2% overall, literally overnight. That's the reduction that we'll have in electricity for use case. But I was looking at these numbers right here. These are terawatt hours, which these are pretty significant when you look at the companies that are in here. This is YouTube running 244 terawatt hours, gold mining at 240, Bitcoin proof of work, and then there was Ethereum proof of work prior, and then Netflix gaming, etc., PayPal down there, and then now ETH proof of stake. To me, this is such a significant flip in terms of where the potential is, because now we're looking at the next layer of potential onboarders coming into the market, meaning a lot of new adoption by people that have maybe never been in crypto before. And this is going to be one of the typical markers that they look at is this token green? Is it something I can invest in? Is my Schwab account or my TD Ameritrade account going to eventually get me into something like that? Do you think this really plays out long-term in terms of adoption when we do see the next adoption curve come, all based on this ESG positioning?
I don't really think so. And I think what's driving this market is, who manages the money? The institutions. Retail is great, but institutions manage the money. Institutions do have very big, very strong ESG mandates. And so Ethereum now becomes very, very attractive for those institutions. I must say, I was taken aback when I saw that 0.2, because you kind of think to yourself, like, Ethereum hasn't even started in terms of adoption. It's already 0.2% of global electricity. That number was huge. We've got to look at both sides of the coin here. If you want a highly secure, decentralized network that is really, really, really unchangeable by governments, and governments can't disturb it, etc., you've got to look at the benefits that proof of work provides versus the cost of proof of work, right? So arguably, if you look now at who owns the validator nodes, and when I say who owns the validator nodes, who are the biggest validators in the market today?
Right.
So it's made up of 3 entities. The first entity is Lido DAO. The second one is Kraken, and the third one is Coinbase, or Coinbase then Kraken. Between them, they have more than 50% of the staked ETH. Okay, now that's fact. If you look at the nodes, I don't have the numbers in front of me, but they between them have over 50% of all the staked ETH, which means that theoretically, if the US government managed to somehow corner all of those guys, they could manipulate the ETH network with a 51% attack. Now, I know that's not really true with Lido, but I'm just giving just showing you the difference between, yes, proof of work consumes a lot of electricity, but you get a lot of benefits for the electricity and stuff like that. Second thing is, if you go look at Michael Saylor's Twitter today, he published a report today showing or debunking the misconception of how ESG unfriendly Bitcoin actually is, right? Look, that said, I'm not saying that Bitcoin is good for the environment. I'm saying that there are trade-offs in life. I think we've got a very good proof of work network in Bitcoin. And I think the best move for Ethereum was exactly proof of stake. And I think that they've made a good move. And now we need to look forward to the rest of the process of sharding and bringing up transaction throughput and down gas fees.
What was and I think that's going to be a big factor, obviously, in kind of moving forward. I do think we'll probably see more institutional movement, especially around Ethereum, just because of the check mark of ESG. And I know right now that's very superficial, but it is a point that so many different Fortune 500 companies have to obviously address. And especially when you get into a certain aspect of the investing population, I think that is going to be a factor. I'm kind of curious because obviously the Bitcoin maxis I feel have already started the process. I'm a big Bitcoin holder, but at the same time, I also believe in Ethereum and altcoins and many of the blockchain initiatives that are being done out there. But when you look at where Bitcoin's position is right now, not that we're pitting one against the other, but it's always going to be a question of which one do you hold more of? Do you hold more Ethereum? Do you hold more Bitcoin? Do you put more in on risk in some of the altcoin projects? Bitcoin, do you think they need to get an identity crisis out in front of this and say, listen, this is really, our initiatives moving forward here are much better now, and we will see a lot of this. Obviously, with what's happened here recently with Biden's orders to essentially go out and research the market, it did reveal quite a bit of things to them. Possibly, we're going to see some legislative scenarios start to occur in this. What do you think Bitcoin has to do to really kind of separate in terms of just the front-facing brand awareness it has, though it's not a brand, but you know what I'm talking about?
So let's quickly go back to the history of Bitcoin. It was launched as a peer-to-peer electronic cash system. That's what it said in the white paper. It didn't play out as a cash system because it wasn't fast enough and it couldn't do enough transactions cheap enough. So then the narrative changed, and the narrative changed to one of this digital gold, which is a great inflation hedge. The problem is that in periods of high inflation, some would argue that Bitcoin didn't perform very well. They're wrong, because if you zoom out and you look at what's happened with inflation and you look at what's happened with Bitcoin over a period, the two correlate very, 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 very well. I think that we've got to just be cognizant of the fact that if you want a decentralized money that is inflation resistant and government shenanigan resistant, there's a cost of that. And the cost of that is high energy. And the amount of energy that is spent in that, to me, is much more valuable than digging a heavy commodity out of the ground, which you then have to store in a vault, which is protected by a whole lot of security guards and police and whatever else, and can be confiscated by governments. With that said, I think you asked a very cool question. You asked the split between Bitcoin and Ethereum in a portfolio. Now, Paul, if I said to you, what would you rather hold in your portfolio? Amazon and Google or gold? No doubt you'd say Amazon and Google, right?
Sure.
And that's exactly how I see the world, the digital world. I love the idea that we have a decentralized store of value that governments can't touch and is inflation resistant. And that's great. But the majority of my money, because of my age and my risk tolerance, I don't want to put into a store of value. I want to put my money into stuff that's going to take over the world and disrupt almost every industry in the world. And that's why, for me, I want to be much more overweight technology, and I don't see Bitcoin as technology. I see
Right.
Bitcoin as just a store of value.
Yeah.
The tech is old. It's almost obsolete, if you want to call it that. It just works. It does what it's supposed to do, like gold works and does what it's supposed to do. And so right now, my portfolio is very much overweight towards alts and growing more and more every day, because as the prices go down, in this bear market, what I decided to do, unlike the previous bear market, is when the prices are down, I'm actually going to get out of Bitcoin and into alts, not the other way around.
Yeah, which I think, a lot of people we've seen kind of start to move in over the last 3 months, start to move into more secure assets, being Bitcoin, and even to a certain extent Ethereum. We just saw quite a bit of movement there in terms of just the wallet address activity. So that I would agree with you. As we start to see the market bleed and really see some of the opportunities out there, in essence, I think, you look at Atom, Near Protocol, some of those that have really been on the high flyer side of things. When you look at that and you also consider kind of just the ERC20 tokens as a whole, where are you watching? Because there's some good opportunities out there right now. I feel like there's more and more because they're, one, price really attractive, and number two is they've got a lot of upside in terms of technological innovation that they're moving. What are you guys watching right now?
So the safest narrative, so let's just go back one step and say we're in a bear market. We don't know how long the bear market's going to last. It looks like it's going to be quite a vicious, tough bear market. This is my third bear market, so I kind of know what to expect, and I'm pacing myself and whatever else. But with that said, you don't know how long it's going to last. And because you don't know how long it's going to last, you need to invest in projects which are definitely going to make it out of this bear market alive. Because the last thing you want to be doing is putting your money into projects that are great, but just won't make the runway. Can make it out. So right now, the focus for me very much is on layer ones. So when I say layer ones, I think that there is still a big deficiency in smart contract layer one processing power. Ethereum can't handle the load. Cardano is not being adopted yet because of technological challenges. Let's just call it that for now. And then you move down and you look at Solana. Solana is doing very well, but does have outages every now and then, but can handle a lot of volume. And the next one you looked at is Near Protocol. And to me, when I look at a protocol like, for example, Near Protocol, I say, hold on a second. Here you have a protocol that works, has sharding, doesn't need a network upgrade, doesn't have downtime, is totally decentralized. And so for me, I'm trying to focus on those layer ones. And then on top of that, I'm looking at base case narratives on top of layer ones that I'm almost certain will get adoption. I'll give you two narratives that I'm watching at the moment. One is obviously decentralized futures and options. So Gains Network, GMX, all those decentralized futures and options. That's one narrative which I'm really paying attention to now. Another narrative which I'm really, really paying attention to now is MEV, or miner extractable value, which is, for those who don't know what it is, it's effectively when you generate an ETH transaction and goes into this thing called a meme pool. A meme pool is a pool where all the transactions go into, and the miners basically collect the transactions and decide which ones they're going to approve. That's a simplistic explanation of what it is. And because the validators can do this, what they can do, because they can see your transaction, is they can actually front run you and sandwich your trade and stuff like that. And that's called miner extractable value. And so one of the narratives is how you prevent that. And so I'm looking at those kind of base case issues, because those are things like commodities that you're going to need. To me, layer one processing power is like oil. You're gonna need oil. You want the economy to work, you're gonna need oil. So that's a sure thing. Exchanges, sure thing. We're gonna be transacting assets. Derivatives, options. In every market in the world, the options and derivative market is actually bigger than the underlying market. Narrative, it's a sure thing. And then MEV, mine extractable value, to me, that's an amazing narrative to be playing.
All right, so you hit on a couple of things there with things like Near Protocol, which I do agree with you in the sense that layer ones there's some big opportunities here for sure. Near being one of the ones that I like in the sense just because of some of the things they're doing, from a project analysis side of things, but also just because of the aspect that it actually is still under, I feel like it doesn't get as much press as what you see some of the others, obviously with Solana and obviously with Cardano, which, by the way, we have just an absolute crazy Cardano hive that kind of surrounds our channel from time to time. So we'll probably get a lot of comments on that one. But I would agree with you on that point. I want to jump over to a couple of things here. And one of the things is when you look at post-merge inflows, one of the things, just like what you did in terms of your strategy in trying to prep for playing this merge, we're seeing a lot of inflows moving back to exchanges right now. Do you feel like this has been mostly because of the fact that people are trying to prep for an opportunity to come into the market? Or do you feel like it was a position where they were saying, wait a minute, we think we're going to play this, from a risk on, risk off approach as an institution? Where do you think those inflows are coming from?
I think that a lot of people were either very, very, very long or very, very, very short into the merge. That's, the options market was at historical levels on Ethereum. It was above Bitcoin. The futures markets were at historical levels. Leverage was at historical high levels. And I think everyone was prepping for the merge. And I actually looked at GMX this morning, and the ratio of longs to shorts was 2-1. When the ratio of longs to short is 2-1, you know that the next move is going to go down. That's exactly what happened. That's exactly what happened. And I think now there's an unwind of the ETH merge trade. Now, I don't think it's going to be an aggressive unwind where all of a sudden the price of ETH is going to go down to crazy levels, but there is going to be an unwind. People who bought too many Ethereum are now putting them on exchanges. People who were over leveraged are now going to unleverage themselves. And so you're going to get that play in place. This was the biggest event, the biggest preconceived event in crypto history in a long time. Like, there were probably bigger events. Probably the Neuner collapse was a bigger event, but that wasn't preconceived. ETH, people had months and months and months to prepare a strategy for this trade. And they took the strategy. Now, I see you showing the chart and the price is 14.96. Question is whether the move in the ETH price was as a result of buy the rumor, sell the merge, or whether it's just a function of the NASDAQ. And, I'm watching the NASDAQ again, it's down almost 3%. You kind of say to yourself, oh man, a great day was actually destroyed by a bad stock market and very bad inflation readings the other day. Exactly. And the inflation readings were absolutely scary when they came out. I think it was Tuesday. Mm-hmm. When I saw the inflation numbers, I'm a bull. I'm a perma bull. I'm always positive. That's just the kind of guy that I am. I saw the inflation numbers and I went pale. And I'll tell you why I went pale when I saw the inflation numbers. The only thing that went down in the inflation, so inflation, CPI went from 8.5 to 8.3. The only component of CPI that actually went down was energy, which is oil. Sorry, which is oil. Well, oil-powered energy, right?
Right.
Now, the reason why that's going down is not because oil prices are going down. Yeah, oil prices are going down. Mm-hmm. But the reason why it's going down is because the Biden administration is selling the U.S. strategic oil reserves to artificially bring down the price of oil. And if that is the only reason why the inflation numbers are coming down, food prices went up, service prices went up, commodity prices were stable. The only thing that went down was oil. And if the only thing that has gone down, that is bringing down inflation, is oil, in a period where the Fed is tightening 375 basis point rate hikes in a row, we're in trouble. Because what it shows is that what the Fed is doing actually isn't working. And the only thing that is working to bring down inflation is this little game that the Biden administration is playing by depleting the U.S. strategic oil reserves to levels not seen in the last 35 or 36 years. That is very, very, very scary.
Well, it is one of the things that we talk about here on the show quite a bit, and just in terms of where the market could be going. Obviously, my position is that we still have some potential pain ahead of us. When you look at what's happening in Europe, obviously there's a lot from the energy dependency side of things, especially around Germany and its connection to Russia, what that might play out and where that might actually go with the strategic move by the Biden organization or administration to sell off reserves, obviously to lower gas prices so they can go to midterms with somewhat of a pseudo reduction in to the most of the population looking at it. That's a win. I see all that, but the real question I have is how this plays out in Europe, especially with Germany. If Germany gets into really dire straits and we see a potential meltdown in the German economy, that has such an effect on what the euro will be doing. And again, the US dollar could be in a really strong position. How would that play out if we do see a lot more pressure in Europe, more so? And how does that affect the crypto markets, do you think, overall?
So Europe is not in a good position at all, because when you're talking about gas prices and oil prices at these levels and electricity prices going through the roof, they're caught between a rock and a hard place. Because on the one hand, they're increasing interest rates. The ECB increased interest rates by 75 basis points, most aggressive interest rate hike that they've had in a long time. At the same time, they're talking about stimulus packages in Germany and in the UK, which will put more money into circulation to soften the blow of the high energy prices. We're not in winter yet. So the way I see it is Europe doesn't realize what's coming for it if nothing changes between Russia and Ukraine. And I was walking today on the Champs-Élysées, as you know, I'm in Paris, and I was walking today on the Champs-Élysées, and I walked past Louis Vuitton and Christian Dior. And outside Louis Vuitton and Christian Dior, there were lines of people waiting to get in. And I was like, this is the funniest recession I've ever seen, where people are lining up to the most expensive stores in the world. So I think, long story short, is we can see the writing on the wall of what's about to happen in Europe, but the man in the street isn't feeling it yet. They haven't felt the effect of these high gas prices, and we're just about to get into winter. We're just about to get into winter here in Europe. I think it's going to be a very cold and very long winter, and I think, I'm not a geopolitical expert, but I think before the end of the winter, something's got to give with Russia. So either pressure from the West on Ukraine to buckle or something, but I can't see it continuing like this because, I think because we're in it, we can see what's about to happen. But I think the average man in the street hasn't felt the huge effects. And so the recession hasn't actually started here. And therefore, I think, to say that we've hit the bottom is very, very, very premature. I think there's at least another leg down. I don't think people are suffering. I think it's too easy. And bear markets are supposed to be difficult. And it hasn't been that difficult yet. It's too easy. There's still people buying the dip. And, one thing I know for sure is for as long as people are buying the dip, we're not at the bottom.
Yeah, for sure. One of the things that I've noticed is this very specific move toward trying to start to influence what's happening in the political arena. And if you look at something like, for instance, this is Brian Armstrong over from Coinbase tweeting, this is something they just integrated into their app, which I was really surprised at this when I saw this the first time. But essentially what they've done here, Ran, is they've integrated all the policy efforts of different politicians and candidates that will all be based within the app on Coinbase. So again, and they give them a score, A being best and an F being the worst. Senator Warren, of course, came in with an F, and then you had Senator Toomey come in with an A, obviously. But the point is that when you have that kind of scenario coming in to first of all, into crypto, and second of all, I think in the sense of what our lawmakers and legislators are going to be really kind of showcased right now. First of all, I think this is going to get into election meddling for Coinbase. They may get a finger pointed at them. But the reality is it may open up a lot of voters to really understand where the positions are for a lot of these candidates. Do you think this makes a difference in terms of legislation in the future?
Well, remember that Biden issued the executive order, and he said the executive order said that they've got to start regulating crypto favorably. I mean, if you read between the lines, what he said is they've got to keep the US as the most competitive, et cetera, et cetera. And one small detail in that report is that 1 in 4 households today own crypto. Now, if you ask yourself, why do 1 in 4 households in the United States hold crypto today? It's not because they're using it because they need to use it or because they're using cool NFTs. It's because they bought crypto because they really and truly believe that crypto is their one hope in 10xing their portfolio or getting life-changing money. Let's just simplify it to that. Now, when you ban it or do something against crypto on an election year, and 1 in 4 households own crypto. That's quite a risky thing to do. That's something that,
Yeah.
if I was a senator or if I was running, I don't know if I'd be playing those games. I think what Coinbase has done is absolutely genius in that, they've now made it quite transparent, and they've almost created a scoreboard for senators and Congress people to try and win the votes of the crypto community through getting a higher rating on. It's like going to a restaurant, and going to Fork or one of those or Eat Out or whatever it is. A Yelp score, and you're like going to go, well, what is this restaurant? Oh, no, I'm not going to go to that restaurant. And that's exactly what Coinbase created. That said, though, people in the US live in the US has everything. And so when you live in the US, you very much live only in the US, so to speak, right? So like your vacations are in the US primarily, and everything you do is in the US, etc. And a lot of Americans don't see outside the US. But for someone who spends most of his time outside the US and a little bit of time in the US, and I look at Coinbase and I go, man, how far could this company be if they didn't have to spend 80% of their days on regulation?
Yeah.
And then I look at Binance and I say, Coinbase and Binance actually started more or less at the same time. I think actually Coinbase had a head start and started before Binance with way better backers, right? And way more money. And if you look at where Coinbase is today and where Binance is today, no doubt that Binance is way further ahead. And you ask yourself why? And that's because Coinbase spends 80% of their time being compliant, where Binance spends 80% of their time building a business. Yeah, and now maybe CZ has gone more towards compliance, but it's to someone who's sitting on the outside, it's such a shame and such a pity that the US is so stringent in its laws and its enforcement. And to be honest, I spent some time in the United States. I lived in New York and I lived a little bit in Miami, not long enough to live, but, long enough to check it out. And one of the reasons why I actually left is I just felt like I want to work in an environment where I can spend my days actually building something amazing. And all the founders that I met in the United States were spending their days navigating regulation, which was unclear and almost impossible to navigate. And I was like, where do I want to be spending my time? And that's where I tapped out and I said, what, let me go and have fun and build an amazing business in crypto and not worry about, whether I've breached the Howey test, which is from the 1930s.
Yeah, for sure. Well, I think the scenario behind the US, and this is something that unfortunately, I had a chance to live through the early days of Silicon Valley and was there and developing with Microsoft. And we had a chance to really understand kind of the evolution of where the internet was going. At that time, the regulators pretty much did a hands-off. And when you look at that, that's essentially what birthed Silicon Valley, what Sand Hill Road grew on, was letting the fact that we had so many regulators that just said, hey, here's kind of a guideline. Before we saw regulation around the internet come a decade later, post the dot-bomb era, and they let companies innovate and run with it. This obviously is a little different because, Rand, you know what you're messing with. You're messing with money. And when you're messing with the banks, things change a little bit.
I was about to say, the difference between the internet, I was around for the dot-com bubble, and this bubble, but not bubble, but this revolution, is that the SEC wasn't scrutinizing every single technology product that was being launched and saying, you're not allowed to do that. You're not allowed to do that. The internet just worked. And yes, there were some telecommunications laws in that, but there wasn't a fight between Gary Gensler, who basically wants to own everything and regulate everything, and then the CFTC, and then at the same time, revenue, and the internet was a piece of technology, and no one had their grubby paws in it. Here, everybody wants to get their grubby paws in it because there's money, and the more money that you can police, the more fines you can levy. The more fines you can levy, the more funded your department is. The better you look, the better your next job becomes. So I think it's a great pity because I think there's a lot of American talent which is unfortunately spending 80% of their time navigating regulation. And if they were just living somewhere else, they would be building amazing things without having to spend 80% of their time on regulation.
Well, I think, it will be a time to tell whether or not we see positive regulation starting to evolve into the marketplace. I think from a standpoint of voters and also just the number of households, as you mentioned earlier, start to shift in that. When you look at this story right here, this is from Fimbold, CFTC obviously talking about, they're already preparing to be kind of the leading crypto regulator. Now, if this comes to fruit and the CFTC ends up getting a chance to really run it and they win the battle with the SEC, and maybe there is a whole new entity that gets formed to handle digital assets, much like what they're talking about in Europe. How much do you think we'll have in terms of some of these tokens like Ethereum that could fall into the securities realm? Or do you think maybe the CFTC could get a lot of these tokens kind of swayed into the commodity side of things? Do you think this is going to kind of be a 50-50 play? How do you see the crypto market shaking out?
The way I see it is the CFTC and the SEC are now playing, it's like a mom and dad who are getting divorced or are divorced, and there's little kids, and really what you want is you want to give the kid the best life in the world, but because mommy and daddy are fighting through lawyers and deciding who's going to have more custody and more power, unfortunately the kids are going to have to suffer as a result. So let's go back to the question that you asked around where this is going to land up. So unfortunately, I think that where this is going to land up is that the majority of them are actually going to be policed by the SEC. And the reason for that is because I think that most of these, specifically in the way that they offered, represent securities. So yes, we can beat around the bush as much as we want, but when someone does sell a token, the buyer does have a reasonable expectation of making money. Typically, so I mean, most of these on issue fail the Howey test. And it's only through very, very, very good legal engineering that some of them believe soon that they can fight it. We've got to call a spade and say that right to date, no one's beaten the SEC. No one's beaten the SEC. Those that have or have tried to fight the SEC have lost a lot of money, continue to lose a lot of money. Most of them don't have deep enough pockets. Ripple does have deep enough pockets and continues to fight the SEC. But ultimately, I think, unfortunately, the SEC is going to police this. Now, question is, does this mean the same SEC as we have today under Gary Gensler?
Right. Yeah.
Or do we maybe get someone like a Hester Peirce in charge at some point, and we get a friendlier SEC? Right now, as it stands, for me, worst case scenario, because you have Gary Gensler, who has a very, very, very intricate understanding of everything to do with blockchain, tokens, Bitcoin, Ethereum. He knows the differences better than anyone. He lectured about it at MIT. So this is the smartest guy in the room when it comes to how these things are made up. And he just wants to control everything. And I remember, to be honest, when we heard that Gary Gensler was coming in to become the chair of the SEC, the Bitcoin price went up because we were all so positive.
Thought it was going to be a good thing. Yeah.
Great thing. We celebrated it. We had a price pump and everything. And I think today, sure, I'd go back to Jake Layton in a heartbeat.
Interesting stuff for sure. Rand, I want to wrap up here with a couple of questions to you around Ethereum, bringing it back home on the topic of the story today. As far as staking is concerned, obviously Binance has been very, very aggressive on doing some stake. I think it's 6% right now currently on Binance, just on the open market. Do you see staking being a big strategy now for a lot of investors? And do you think we'll start to see a lot more node operators start to appear? I was looking at some new data that we're already starting to see the amount of people holding 32 ETH has increased dramatically. So do you think that's something that we'll continue to see rise?
So let's just separate staking, real staking versus staking.
A node operator.
So staking to become a node validator, to become a proof of stake validator is, I think, a strategy which everyone must adopt, and we'll talk about that in 1 second. Staking so that you can lend your crypto to somebody else who wants to borrow crypto, be very, very, very wary of it, because most of those entities are centralized and you'll lose your money. That's not staking. So if you stake in Ethereum, in Cardano, in Solana, and you're staking to become a node validator, which is what you're doing, you're either becoming a node validator yourself, or you're delegating that right to somebody else for a small fee. You have to be doing that. And I'll tell you why you have to be doing it. The first thing is, when assets are priced, it's like when a property is priced. When you price a property, you price two components. You price capital appreciation, which is essentially usage of the network, because capital appreciation is actually a function of how much the usage of a network is going to be. And the second part of when you're pricing a property is the yield that you're going to get from renting out the property, right? So that's how you price a property. And if you own a property and you're not renting it on the open market, then you're losing yield. You're losing the yield that makes up the fair value of the yield. So, let's say that a fair return on investment is 10% for a property. 5% of it is made up of capital growth, and the other 5% is made up of yield. It's the same thing with crypto. When you're buying crypto and there is a risk return parameter, you're buying crypto because you want capital appreciation and yield. And if you're not using the yield, you've given up a significant amount of the return, and it's going to become more and more significant because as time goes by, the bad news is that prices aren't going to increase exponentially forever, and that we're going to have to get smarter on where we get our yield and how we get our yield. That's the first reason why you have to stake. The second reason why you have to stake is because decentralized networks only work because there is a community that is passionate and protects and participates in the network. Now, to participate in the network, you can do multiple things. You can volunteer at a conference. You can write code. You can participate in the building of the protocol. But if you don't have all those skills and all that time, the most basic thing that you can do is secure the network. And how do you secure the network? It's very simple. You either become a node or a validator on your own, or if you're not technical and you don't feel like the headache, you just delegate it to someone else. But you almost have a moral obligation to the network, to the community, to be doing your bit and not just be a free rider in this economy.
Yeah, you can see the chart right there. I mean, look at the 32 ETH growing. And I think that's going to be a big factor. Obviously now with the fact that just the process, I was looking into Rocket Pool and some of the processes there. Very simple. Obviously you could do it with 16 ETH. There's going to be a lot of growth in this area for sure. Ran, I want to get into winners and losers here real quick. Before we wrap up, we'll take a couple questions. Now that the merge is done and we've got a successful merge behind us, let's take a look at some of these tokens right here. So you've got Binance Smart Chain, BSC. Do you think this continues to grow? Do you think we're going to continue to see growth there? Kind of thumbs up, thumbs down. What are your thoughts?
I hate to say it, but yes, I think BSC is going to continue to grow. It's one of those chains that hasn't got much downtime, works really, really well, is very fast, and is very cheap. And has been like that for a long, long, long time. And then the good news here with BSC chain is if you hold the BNB token, you kind of got a hedge. So if the chain doesn't do that well, rest assured the exchange is going to do well. So to me, definitely one that I'm adding to my portfolio. Also, if you go and look at the BNB token relative to the Bitcoin token, BNB's outperformed Bitcoin by over a factor of over 100 in the last couple of years. So you got to be holding BNB. You got to be holding the BSC chain.
Moving on to Cardano, thoughts there? You like this long-term, short-term?
I'm so scared to say something about Cardano because I know what's going to happen is going to be chopped up and put all over Twitter. So let me be as clear as I can and as diplomatic as I can. I love Charles. I love the technology that Cardano is and has built. And I love the fact that they are so thorough in their processes to launch. They test and retest and white paper and research. Problem is they're taking too long to launch.
Too long.
And it's and I don't know anybody that uses any Cardano apps. And I know that later on they'll cut this up and say, I did this and I did this and I did this. The reality is they need to either, I don't know if I can say this on your show, but I'm going to say it and you can cut it out if you want to cut it out. But they need to either shit or get off the toilet. Just decide, is this thing going to work? If it is, then let's get it work, or not, and then just get off the toilet. But let's pick a side here.
All right, so ETH Classic, no life ahead of it, or is this going to play out? It's over. Okay. Solana, I know you kind of like Solana.
Nobody builds on ETH Classic. Nothing's built on ETH Classic. All of a sudden, the miners who don't want to switch off their machines because they've got such high sunk costs have migrated their hash power, and everyone's following the miners. Yep. Guys, alert. You don't follow miners. Miners follow usage to secure networks. Users don't follow miners and build applications. So move on. No ETH Classic for me.
Solana, Polkadot,
Love
Avalanche.
Solana. Love
Polkadot.
Solana. Love Solana. Solana was supposed to be a DeFi and trading protocol. It has become an NFT protocol. Highest active user base on crypto by a factor of 10. Love Solana. Think it's got a great future ahead of it. Polkadot. Love the idea of connecting a whole lot of chains. Unfortunately, we now realize that charging chains to stake tokens in an auction to win a chance to be a parachain maybe isn't the best model. So to be honest, love the technology, but just not adding any Polkadot to my bags.
Avalanche.
Yeah, good technology. Don't see the use for it once ETH solves its problems and the fact that Matic and Polygon actually exist. Also, their tokenomics, because they created a subchain network where any chain can be a subchain, and the fees can be paid in the denomination of the subchain, it destroys the token. So I think it's a good piece of tech, but personally, I'm not adding too much Avalanche to my bags. In fact, I'm not adding any.
Interesting. All right, so that kind of rounds it out. I think we had a few others there, but I think this is a good lineup, and we'll get into, I know we have a poll coming in. Let's take a quick look at the poll. All right, can Ethereum's deflationary aspect combat negative macro pressures within the next year? Looks like a little bit over half the audience coming in at 54% yes. So do you feel like that's going to be the case over the next year?
It depends how bad the macro pressures get, to be honest. And I think that, as I said, I think the macro pressures have one more steep leg down. And unfortunately, I think that crypto is like an elastic band. It's going to be highly leveraged to that move down. That's what's going to happen.
Yeah, for sure. A couple of questions here. Near protocol just wasn't in that chart. This came over from CoinMarketCap, so Near wasn't in it. But I know Rand likes Near. I'm a big fan of Near, where it's going. Why haven't the yields gone up with the ETH post-merge? Obviously, Binance was doing 6%. Do you think we'll see a climb in yields, or do you think we'll see a little bit of,
Can we touch on Near protocol just? Can we touch on Near protocol just for 1 second? Because we've mentioned it twice in the show. Let's just touch on it for 1 second. So, I went to NearCon in Lisbon last week, and when I went there, I always knew that Near was a very good piece of technology, but my perception is great piece of technology built by very smart people that lacked a marketing department. So they didn't have the same hype, etc., as Solana and everyone else. But I went to NearCon and I realized that these guys are amazing executors, amazing shippers, that there is brain power like no other building on Near. And the main thing is that Near actually works. Sharding works. It doesn't need any network upgrades. It's fast. It's cheap. It's decentralized. So for me, Near right now is the one that I'm adding the most to in my portfolio, because I've seen the light and I've spent the time with the devs and I've seen who's building what. And to me, it's a no-brainer. No downtime, has sharding, doesn't need any network upgrades. So that's how I see Near. What was the next question?
Near protocol was one, but the other aspect was whether or not we would see potential growth in yields. Obviously, we saw Binance at 6%. There's been others out there that are a little bit higher even. Do you think we'll see continued growth in yields now that we're on post-merge activities, or do you think we'll possibly see yields go down?
So when you look at Binance, you're looking at a centralized aggregator of yield. And that's not the best place to go look at yield. You should go and look directly at the on-chain yield that is being generated, for every ETH that is, for every transaction that is validated. I've seen a couple of models. The lowest model that I've seen is about 6%, and the highest model that I've seen is at about 15%. So to me, it's a function of network usage and the Ethereum price. That's kind of like what the function is.
Right.
So I think 6% is on the very conservative side. I'd be surprised if we don't get to 8 or 10% when the market slightly recovers.
Yeah, for sure. And for those of you guys, you probably already know this, on our own power index, we actually introduced Near protocol, so you can actually get to the sentiment data on the CPI, so it's very easy to do that now. That was added about 2 months ago when we put Near into the system. And make sure and drop some comments in below, because we're adding tokens every week to every 2 weeks, trying to get more and more sentiment data harvesting there. So I know there's many tokens that we don't cover that you guys want, so just drop them in the comments below. All right,
That
so
sentiment data that you guys have is a very, very, very powerful tool. It is. I mean, I love it. It's a very, very, very powerful tool. It's sentiment is everything.
Well, especially this market is kind of unique. I've been in a lot of different industries, and one of the things that was, I guess, mind-blowing to me the first time I started to look at the data science behind what was happening within the crypto markets was just how close sentiment runs to price action. It doesn't necessarily run like that in other markets. If you look at other Fortune 500 industries, you don't have that kind of connectivity to the grassroots element of what's happening in crypto versus crypto itself, because there's no real fundamental quarterly earnings, the traditional triage that you go through like a stock. It is all built on what's happening on Twitter, what's happening in social media, on the blogs, on Telegram, all these different source data points that really kind of indicate where the market is flowing for sure. What do you think about?
Two or three reasons for that. There's two or three reasons for that. One is that the crypto market is open 24/7, and the traditional markets close and are regulated in terms of moves up and moves down before they sometimes halt trading, etc. Second thing is crypto is rather illiquid. So when you have a rather illiquid market with a global audience, that's the third thing. So you've got a global audience. Global audience, there's no other market in the world that trades globally 24/7. And we're all buying the same Near protocol, or we're all buying the same Solana. And like even oil, which is a global market, you're either buying Brent or you're buying WTI, or you're buying. We're all buying the same asset here, 24/7, 365, and it's an illiquid asset, which is why in this game, as you say, sentiment is everything. And that's why your sentiment indicators are so powerful. What I found with your sentiment indicators is that you can pick up early moves. You can pick up early moves in tokens if you just watch those sentiment indicators.
Yeah. That's the thing that we stay very tight to. So it is something that is going. Last question for you, XRP, Ripple, where this is going. Obviously, who knows how this case is going to end up, but obviously we talk about this a lot here on our show. We have Deaton on a couple times, really kind of indicating where he thinks it's going to happen. What's your feeling on XRP right now?
I think I'm candidly against XRP. But I also believe because when I was very young, my mom used to say to me, everyone on earth has a purpose. And I think even XRP on earth has a purpose. And the purpose of XRP is so that Ripple can beat the SEC. So for me, the reason why I'm so supportive of Ripple now is because I just think Ripple needs to beat the SEC. That's their purpose for being on earth. In terms of the XRP token, I don't have any in my portfolio. I'm quite transparent about why. Not saying that I'd be adding to my portfolio.
Yeah, excellent. Hey, Rand, it's been great having you on the show today. We appreciate you stopping in. Take some time out of your busy schedule. I know you guys are up to a lot, so we really appreciate you stopping in. Thanks a lot.
Well, great honor, and thank you so much, my friend. Keep doing the amazing work. As I said before, I'm a huge fan of the channel.
Thank you. Appreciate it. All right, you guys are listening in on the podcast maybe side of things here, maybe post the live. This is where you want to catch everything is over here on YouTube. This is where you can catch interviews like this, a lot of the breakdowns, and even when we do our macro analytics, as well as our sentiment data breakdowns, a lot of our charts, all that happens right here on the YouTube channel. We've got a lot happening here with some new additional channels coming on, a ton of stuff. So make sure to stay tuned and hit the like button on some of these videos. In a way, it's going to give it into your feed. Obviously, it's going to get, hopefully, into your hearts, and you guys can hit the subscribe button. We've earned your trust. And of course, if you guys want to reach me, it is out there on Twitter @PaulBaron. We'll catch you next time right here on TechPath.